Good morning and welcome to MarketCast 27. And I make no apologies for two things. The first, saying Happy New Year, because it's the first time we've spoken really, isn't it, since 2024. And the second, for the flamingo shirt, which I hope you'll agree is nothing short of spectacular. But what I'd like to do, before we get into the MarketCast 27, I feel it's only fair that we actually just take a little look back over the predictions that I made for the market last year. You can't get away with it, unfortunately. All this stuff is documented, so when you make forecasts, they all get logged and they are all discoverable. So I thought I ought to do the back to school and open my exam results. I wasn't helped. Can I just say, I wasn't helped by some of the actions of our government and that last budget, which saw an unexpected uplift to the numbers as we came through to the end of the year. But okay, let's just have a quick look in detail. We'll leave Diplodocus off to one side and have a little look at the detail here. This was what I said. This is what I offered you in January 2024. So this time last year, this is the chart that I put in front of you. And my take on it was that we were going to see an uplift going into spring of 2024. And then as we came into the summer, I thought the various things that were going on in the background, and of course the continuing crisis in Ukraine and inflation and everything else, gave all the reasons. Won't bore you again with them this morning. But we saw then that the growth turning negative in the middle of the year before it came back to finish round about zero at the end of 2024. And I stayed with those numbers pretty much through the whole of 2024 up until the very end, about 3 or 4 months out. I think I said, okay, I will bow to the inevitable that we are going to finish in positive growth for the year. Fortunately, I remember the first couple of market casts, we put the slide up saying there is not going to be a crash. Around this time back here, after an incredibly difficult 2023, the last quarter of 2023 was insanely difficult. And there were lots of talk about plunges and plummets and crashes and so on. And I think we did a pretty good job on making sure everybody realized that that wasn't going to happen. However, stand and be judged. At this point here, I was doing really well. In fact, you could have pretty much taken my forecast chart and plotted it against the actual and we'd have been bang on. And then unfortunately, it all went awry because that forecast of the price moving back in the summer just simply didn't materialize. And the average price, according to the Nationwide, which is what I use as my yardstick, consistent inconsistencies. We know it's not perfect, but it is consistent. And that average price for a property in the UK just continued to climb through the year. Surprising pretty much everyone, I think, not least me, much more so some of the big national agents who actually saw negative growth in 2024 at the start of the year. So I'm going to award myself B-. B- must do better. I think I'm going to do better this year. But I think quite aside from the way that average prices are going to move, this morning for our January market cast, there's something much more important to talk about. And I think this is something that I feel pretty sure, bearing in mind that the vast majority of the audience of this market cast is new homes industry related, I feel pretty sure that you will be focusing on this already. But we will take a look over the next 25 minutes or so. We will take a look at what 2025 has in store, what the year holds for us in terms of the way that prices and volumes are going to move. But much more importantly, I think we need to focus right now on the first half of this year, which is going to be ripped apart by the changes to stamp duty land tax. I've invented a new word for it. Look at this. Well, it's not invented a new word, is it? It's the old word, but stampede. It's a stamp. Okay, all right. I'm wasted here. I expected at least a round of applause from the production team. I got nothing. The stampede has already begun. What I've done is I've stolen some of Chris Watkins' numbers that he takes from the 20 EA data. and publishes on a weekly basis. I follow these numbers, I find them very interesting. And again, I think consistent inconsistencies, but measuring that data, measuring it in a consistent way and watching the way it moves builds a great trend. And it was really interesting to see that already activity has picked up significantly in the first week here and it's a funny week because of the day on which it started. I think Chris Watkin in his video actually explains that. But you can see here that listings, 27,000 listings according to EA and 20 EA data here. The highest number of listings in that first week, right back to the numbers that I've got that go back to 2017. Gross sales, with the exception here of 2021, you can see gross sales here up at 19,000. And if you look at accumulated net sales, well, again, aside from 2021, it's the best year since 2017, which are the as far back as I've got for these particular set of data. In my mind, there is no question that already people are asking, if I buy this, am I going to be able to complete before March the 31st? The stamp duty change is going to have a dramatic effect on the market, and we'll take a look at that in a little bit of detail. And what I'm going to try and do is I'm going to try and quantify what that actually means to you, and then what we can think about doing. I want to try and bring it down to actual numbers and give you a sense of what that really means. So right now, today, this MarketCast is all about stamp duty, and it's also all about interest rates as well. As we predicted, and going right back to last December, the stamp duty concession ending March going to have a dramatic effect on the market. Finding a way to take advantage of this spike and drop in demand, this extraordinary wave that's going to happen, is absolutely crucial. Inflation being pegged back, that happened. It was a really good piece of news on inflation last week, wasn't it? That actually came back 0.1 of a percentage point to 2.5. That means there's half a chance we might see an interest rate fall on Feb 8, but we'll come to that in a moment or two as well. But despite the changes that we're going to see, the distortion in volumes that we're going to see through this year, and I absolutely guarantee we are going to see them during this year, I think that we're going to go back to the faithful 5 in terms of overall volumes and overall new home share of the market. That classic 1.2 million sales in the year, around about 100,000 sales averaged out per calendar month. That's the sort of prospect I think that we've got ahead of us as far as the year is concerned. But this is the crucial thing. This is a chart that I actually put up. This is a slide that was in the deck for the December MarketCast. It's still absolutely valid now as it was then. This is Zoopla produced this, but I thought it was great. It's a really easy way to see what's changing. And you can see that right now we're in this area here where 80% of first-time buyers pay no stamp duty whatsoever. That's going to change to just 60% of first-time buyers paying no stamp duty. And you can see the number of people paying, first-time buyers, paying full stamp duty doubles from 6% to 12%. Two really important things there. One, it's a big number. It's thousands of pounds. Two, it is the second most hated tax in the UK after inheritance tax. People hate paying stamp duty, and they will do anything they can, legally of course, to avoid it as far as humanly possible. So that is going to have a big effect. I also showed you this slide in the December deck. I'm not rerunning the December deck here. This is not laziness coming in. It's just these two slides. This one, to be fair, I have updated this one. This has got the latest month's numbers in it. But the point is that it's crucial to what I'm going to say next, because the Nationwide have painted this chart here. It's such a delightful demonstration of the effect that stamp duty changes has in terms of volumes. And you can see, even, look, here, the faithful 5 that I often refer to, 2014, 2019, 1.2 million transactions a year. That's here, look, that's here, that's there. But look what happened in the middle of that in 2016. And do you know what? That was caused by the change in stamp duty for people buying second properties. The buy-to-let investors, so the investors in residential property, not as their main residence. Just that change the end of what got termed as a concession, but the imposition of the additional tax, that's what happened with people rushing in to try and beat that change in stamp duty and the additional tax. This was the COVID-related stuff. And even in here, if you actually look really closely in here, there are 3 peaks in here. 3 peaks. That's because the government kept changing their mind. When they said we're going to end this concession and they gave a date and the whole industry went, no, there's no way that we will be able to get these properties complete by that date. So, okay, we'll extend it then. And they extended it and then they did it again. So you've got 3 peaks where everybody rushed and a few people couldn't make it, got extended, so they all rushed to get you. Hey, you get the picture. The important point is this. Stamp duty has a massive effect on buyer behaviour. I've tried to simplify it over the next couple of slides. I've stuck on this slide here volumes of sales in March going back here to 2014. The faithful 5 years are all included in there. So this, every single entry on here on each year is just the month of March, which is where the changes have happened. Here we go. This is a normal March for you here. 2016, 2021. See if we can quantify those numbers a little more accurately. If you actually look at 2016, I'm going to leave 2021 off to one side because that was COVID, and so that market was distorted by a lot of other things other than just the stamp duty change. And we know that, and we know how we ran into early 2022 with the market overheating it with the release from lockdown in 2021, and this is when interest rates, of course, were at 0.5%. The market went absolutely bonkers. So we'll leave 2021 off to one side. 2016 is a much more accurate way of us forecasting what's going to happen this year. This is what happened so what we'll do is we'll take the red number, because the red number is seasonally adjusted, and you know, these are HMRC numbers and they go back after the event and then change all the data. But it will follow that red number. So here we come in 100,000, roughly, 100,000, 170,000 completions in March. Crazy. And then, boom, a dip down there to below 80,000 in April, and then a rebuild. So you sort of get a suck out, like that, you know, like almost like that tsunami thing where all the water disappears before the big wave comes over the top. And you can see what happens, and then again you get that dip, don't you, after all of these people have got these properties here completed. So I sat down. It's all very well me showing you this chart, but the one thing, whenever I'm doing presentations, whoever it's to, and particularly in MarketCast, I always like to apply the so what principle to it. So what does that actually mean to you? I tried to work out some numbers. Stay with me on this, okay? So an educated guess first about what I believe the volumes are going to be in the first 6 months of 2025. I think January, we're going to see ourselves faithful 5 style as this is starting to build now, volume is starting to build now, 95 to 100K probably. February, going to get that little bit of dip, that tsunami dip, maybe 85 to 90K. Going to come into March and it's going to zoom. I don't think it's going to reach the 170 because the changes aren't as dramatic as they were in 2016 or in 2021, come to that. But I think that we will see volumes up in March between 160 and 165K. But what that means is that in April, we'll see volumes fall to 70 to 75K, and then we'll start to come back up and balance out, just as I've showed you, just on that last slide, just as happened in 2016. And then by the time we get to June, I think we'll start to be back on the sort of even keel that we would expect on a faithful 5 year. So this is a really important point to make, and I can prove it. I can go back over the last 30 years that as volumes fall, the new home share of the market rises because builders have got no choice. If they build a house, you've got to sell it. What tends to happen to make that market share rise is that margins fall, sorry. So that is probably the best example I can give you is 2009. Remember, after the 2008 massive meltdown and crash, New homes share of the market in 2007 was around 10%, 10.1%. In 2009, it was 16% because no one else was selling. The builders had to sell. So that's the point I'm making here. Now, if we assume that in Jan and Feb, say, that the margins, that the market share for new build against second-hand would be around 10.5%, and then let's then say that in April that actually rises to 12.5% because the market has dipped. The key question here then on market share is what that means to you in terms of sales per live site. Well, I've sort of worked that out. If you work on the basis, let's just assume, for the sake of argument and maths, that there are 2,000 live sites roughly in the UK right now. Well, on that basis then, that is going to take you from a sales rate of 0.9 to 1, even breaking through the 1 barrier into the +1 barrier in March, down to 0.5 in April. The sales rate, the natural sales rate between those 2 months there is going to almost halve. Now, I hope I'm giving you some idea of why this is so important. So right now, the work that needs to be going on is identifying the plots that are going to need to be sold post-March, but that won't complete before March 31, and then putting together a package which actually compensates potential buyers for missing out on stamp duty. And far be it from me to suggest that we put marketing hype or advertising blush on any of our propositions. But whatever you do with that package, get hold of your IFAs, by the way. They need to be in the room when this is discussed. But whatever you do in that package, let's just tell everybody we're saving them stamp duty. You get my drift. You obviously, legally, they have to pay their stamp duty, but essentially that compensation for that means that they are avoiding paying a stamp duty penalty. And believe you me, that will give you a huge opportunity to increase your market share in April and May. Very, very important. I'm sure you're all planning on that right now, but so you'll excuse me taking a bit more time than usual on there. A quick trot then through some of the data that will take us into the forecast from where we're going to be for the year. Super important, the inflation numbers, next set of inflation numbers come out on the 19th of February. And right now the mood is pretty good. I'm sure you're all aware that a little bit later on today, there's somebody's getting inaugurated somewhere. America, is it, or something? I don't know. I can't remember the guy's name, but apparently there's a new president or something coming along. And he is going to tend to have quite an impact on world markets, on interest rates, and obviously on inflation. The inflation numbers in the UK matter to us enormously. And as borrowing costs and what have you go up, then inflation tends to go with that too. The last budget that Rachel Reeves set with a huge £40 billion tax hike was highly inflationary. So we've all got to hold our breath a little bit and hope that actually inflation stays under control for that meeting there. This is where we are with inflation. And of course, this is the naughty little tinker in here, which is the owner-occupier housing costs. So although CPI, the Consumer Price Index, and CPIH, Consumer Price Index with housing costs included in it, have now started to look as though they're going to level out after this nasty little blip back up here from around 2%, you can see that these OOH costs here still sit at 8%, and that's a concern. Fingers crossed there, nothing much we can do about that. Of course, the big deal for us that really will set the seal for the way that February and March works is the MPC meeting on February the 6th. I think I said February the 8th just now. Sorry, I meant February the 6th. And they, of course, are going to then make their call on the next round of interest rates, or base rate certainly. And I think that given the last inflation data, given the way the UK economy is starting to look, there's every chance we could see a 25 point cut in base rates on February the 6th. I reckon 50-50 in my view. Where does that leave us in terms of consumer confidence? And don't forget, I showed you in December how closely allied consumer confidence is to the way, to the number of deals that are done at asking price or better. And you can see people's confidence in their own personal finances still just bobbles along that central line there. It makes people pause and makes them difficult to get over the line with regard to property deals and to get them to do deals. If we look at the overall index, after the big dip leading up to and just after the last budget, which as I'm sure you recall is at the end of October, and we saw this huge dip down here in terms of confidence, there has been a slight comeback from there, and you can see we're bobbling along. I think people are now waiting to see what's going to happen next. It's interesting because I painted on here last time round this line, which are deals done at above or asking, and it is quite extraordinary how closely that correlates to confidence. And you can see as the stampede, I'm really very pleased with that. You probably noticed as the stampede actually picks up pace towards the end of last year and in the first couple of months of this year, deals are being done, more deals are being done at asking price or better. That in itself is really quite an interesting thing. And quick look at the indices. This is how Rightmove finished the year, and you can see here minus 1.7% on asking prices. It's pretty much what we thought it would be on asking prices, and certainly pretty much what they thought it would be. I picked out a couple of things out of their executive summary I felt worth sharing here. Rightmove predicts that new seller asking prices will rise by 4% in 2025. That's interesting, isn't it? Asking prices, no relation to selling prices, but 4% rise there. And I thought this was interesting as well. Buyer demand jumped 273% between Christmas Day lull and Boxing Day, which is higher than normal. The stampede has begun. This is how Zoopla ended the year, up 1.9%, pretty much exactly where they thought they would be. Richard, Donald, clever man. I think they said about 1%, didn't they? And they ended up at about 1.9%. But you can see here, this is their prediction here. The projection for annual UK house price inflation over 2025, 2.5%. So that's where they're coming from. So you've got Rightmove saying prices up by 4%, asking prices up by 4%. Zoopla saying that their general prices on their algorithm, which includes asking prices, mortgage approvals, sold prices, 2.5%. The volumes are coming back to where we were. This is the faithful 5 in here. You can see where the faithful 5 was before COVID struck, and I believe we're headed back that way. And if you actually look at those numbers there, 68,000 mortgage approvals in October, and it's always 2/3 of the total as a rule of thumb. So if you get 66,000 mortgage approvals, you're going to get 100,000 completions 3 months then further down the line. It's another reason why I believe we're heading back to that steady volume after the stamp duty hiatus, of course. So RICS, won't dwell on this for any amount of time really. This is the December survey here. But it's interesting to see here that they had sales volumes improving slightly in December. Look at this bottom line here from the most pessimistic institution involved in the residential property market. House prices now seen rising in all parts of the UK. It's the stampede. You can take my word for that. Just quick look at their sales expectations and their price expectations. So don't forget, these are members of the RICS. And this is the percentage that believe things will get better as against things will get worse. And if you look here, the light azure blue line here, green, whatever you want to call it, is better over the next 12 months. The mauve line, better over the next 3 months. And you can see in terms of volumes, a very strong percentage believe that things will get better, both short and longer term. And if you look at prices, well, prices over the next year. These are surveyors, by the way. These are people that do the valuations, and you can see where they've gone in terms of how they feel about prices and where prices are going to go in the next 12 months. A really strong indication that we're going to see prices rise over the next 12 months. So then crucially, where to in 2025? Now this is tough. This is what happened in 2024. This is the chart that I showed you right at the start here. And we actually had nationwide, I didn't bother putting the nationwide annual chart up when we were going through the major indices because you got it right here. But they ended up with 4.7 inflation for an average price in the UK on their index compared to that time last year. 4.7% higher, way above, I think, as far as I can see by looking through what was available and out there, way above what anybody predicted, and of course above what I predicted too. But we said that we'd stay in positive territory, and so we did. So we saw the average price of a property in the UK come up to touch almost £270,000, an absolute record. So where next year then? Well, this is as I see it, and again, you mad fool, I hear you say. But then again, I've gone for this dip in the middle of the year in this year. I don't necessarily know that it's gonna fall into negative, but I cannot believe that post the rush that there's going to be, the stamp E that there's going to be in March, and that dip afterwards into April, that isn't going to have an effect on prices as we come into the summer. So you can see, I mean, here we are, we're coming in with a big high inflation number at 4.7% that we've come in from last year. So I think that will stay pretty much where it is in the January. That simply will not be maintained in my view. I think that is absolutely going to fall. Even in the February and March numbers, despite that uplift in volume, I think we'll get a slight increase in actual average price. But in terms of inflation over this time last year, that will start to come down, but still they're just under 3.5%. And then that inflation number will start to dip into the summer. I feel confident about that, but I feel equally confident that we'll see a rise coming out of the summer and into the back end. Obviously, there are countless things that could happen geopolitically that have an effect literally. So something that Donald Trump and President Putin might agree in Moscow or Reykjavik or whatever on Thursday could well affect the cost of that semi-detached house in Station Road in Oldham on the Friday. They can really be almost that directly related. So geopolitical things can obviously change the landscape dramatically, but I think given the playing field as it currently stands, I see this price growth as we come out. I see that the nationwide index will end the year at around 273k for the average price of a property in the UK. And that will mean that we've got inflation there sitting at about 1.5%. So I'm not quite as bullish as Richard Donald for the year. I know last year I went 0 and we ended up at 4.7%. This year I'm going to go between 1 and 2%. I think that's where we will end up with everything as it currently stands, notwithstanding potential changes. And of course, when you've got somebody like Donald Trump in the White House, changes can happen really quickly, absolutely, and very dramatically too. It will be interesting to see what happens tomorrow, because I think he did claim in his run-up to the presidential election that he was going to solve the conflict in Ukraine between Russia and Ukraine in one day, didn't he? So I'm not sure which day he's got in mind. So, so the war is probably going to stop on Tuesday or Wednesday. So we'll see how he gets on with that. But anyway, here we go. Quick summary then as we run towards the top of the hour. So decision to end the stamp duty concessions dramatically distort the market. I think I can't believe that I could find any more proof than to show you what's happened in the past. I do hope that you get how certain I am that there will be that market distortion in March and in April. So, in bold, finding a way to take advantage for the demand for completions prior to the end of March is absolutely crucial. I'm sure you're all working on that right now. But as important is creating the package for those plots that you cannot complete before the 31st of March to make sure that we see market share then rise as overall volumes dip as we go into April and May. The unexpected uplift in values, and it really, truly was unexpected, it's changed my view on annual inflation for next year, which I originally was thinking back in November, December, I was thinking 2.5%. I've brought that down, and I think that's going to be close to 1.5%. Despite the change, the distortions in volumes of stamp duty, I do believe that we are going to end up at about 1.2 million for the year, back to the faithful 5, and I think the new home share this year is going to close close to 10%. So there we go. That's my predictions for the year. Hard at work now, sorting ourselves out, ready for what's going to happen in February, March, April and May. Just before I go, and I'm almost running to time this morning. It was a New Year's resolution. I just want to say we did the shirt auction, didn't we, at the back end of last year? And I want to say a huge thank you to all of you who bid for shirts in that auction. It was a lot of fun. We raised 875 quid from selling shirts, which I just think is brilliant, and put that into the pot for what AF Oliver did throughout the year, and it's extraordinary. That means that the cancer charity actually received 18,000, once you allow for the tax concession there, 18,000 over the year. So we made a valid contribution and to that overall total. And don't forget, my offer's still out there and it still stands. To any of you that bought a shirt in the auction, get it out there on LinkedIn, tag me in on it, and then I'll stick another 50 quid into that charity for you as well. So that offer is there. See if you can fit into them, because I'm very slim, so I know it's tricky. Okay, I think we're there. I will let you have the date for our February market cast as soon as possible. I hope you enjoyed this January one. We're almost bang on time, a few seconds over right at the end there, just to update you on the position with the shirts. But plans underway now then, everybody. Here we go, February, March, for the Stampede. And don't forget, you heard that term here first. See you in February.